Designing and constructing buildings takes place over many years, with many people collaborating together. In the Brick and Wonder podcast, we have conversations with people who work together to realize a collective vision. I spoke with two people whose collaborations evolved into years of partnership. Seth Weissman, the founder and president of Urban Standard Capital, a real estate private equity firm focused on debt and equity investments across the United States. Seth says he wants to go on a rewarding, challenging, and collaborative journey with his clients, and to do so again and again with people he likes and trusts.
We want to have fun doing this, and we're looking for people that are passionate and fun and bring that to a project.
And Josef Goodman, the founder and principal of Haussmann Development, a New York City-based residential real estate developer who selects his projects and collaborators carefully, including Seth and the Urban Standard team, with whom he has completed 5 project loans to date.
You were looking for long-term partnership, right? So we've done now how many deals together? 5 loans?
I think that's right, yeah.
But it's been a fruitful partnership.
I'm Drew Lang, the founder of Brick and Wonder. This is the Brick and Wonder podcast. Seth, Joseph, welcome to the Brick and Wonder podcast.
All right, great. Great to be here.
Thank you for having us.
How nervous are you, Seth?
I'm really nervous.
Yeah, you should be.
I'm nervous.
Going up against me?
I'm the one who should be nervous with you guys. So let's kick off by hearing about how you guys met originally and what were your first impressions of each other?
Well, so we were introduced originally, I want to say maybe 5-6 years ago by an architect, Matthias.
Yep.
He had designed the building for me on Flatbush Avenue. I ended up not progressing with it. And I guess he was like, Joseph, you must be so desperate for a loan. Can I introduce you to my friend Seth? At the time, I wasn't very bankable. And as such, I had very few options. But it was Matthias who put us in touch. And he later went on to design something for you. And the joke has always been ever since that he had one design for me, and the design that he ended up giving Seth was basically the exact copy and paste. Like the brick was the same.
Yeah, it was a beautiful design.
I was
like, this
one-trick pony.
Very familiar. No, he's super talented. But
yeah. But I think what impressed me about Seth, well, you an Ivy Leaguer, right? You don't meet too many of those. Wait a second. You don't make too many of those. But, Seth was very friendly, very nice. I think you approach things as a rational real estate actor, which is unique, makes you almost exceptional. And you were looking for, long-term partnership, right? So we've done now how many deals together? 5 loans?
I think that's right, yeah.
But it's been a fruitful partnership.
Yeah, so, I think, for us, beyond focusing on people that, of course, are active and good at execution.
Check.
and
Check.
Yeah, trustworthy,
Check.
Honest. Like, we want to have fun doing this, and we're looking for people that are passionate and fun and bring that to a project. And Joseph, to your credit, you bring all those things. So it was like an immediate, positive reaction. And, it was earlier in your career, which for us is not that uncommon because, we are open to starting out and growing a relationship. We have numerous folks that we started off with loans that were, a couple $1 million that, grew to 10 million and 20 million and 30 million plus. And we like that narrative because you're sort of going through that entrepreneurial journey together. You're making mistakes, hopefully learning from them. And that's the spirit of how we approach things. I mean, most of our business, almost 80% is repeat clients or direct referrals. We actually last month closed a loan that was our 27th loan with that borrower.
Joseph, you have a lot to live up to.
I do. 27 is quite a number.
It is quite a number.
What are the criteria for evaluating people and projects, right? Like, does the team have a set of criteria as they pertain to Joseph and other people who are coming to you?
Yeah, I mean, there's a couple things that we're looking for. First, at the project or real estate level, it sounds sort of obvious and stupid, does a pencil, right? A lot of times you see stuff and, there's no comps to support the exit value or sales. And you really want somebody, that not only has a good project that pencils, but also is capable. And, it sounds obvious, but, for us, like focusing on and betting on the horse and betting on the jockey are two really important things, because when something goes sideways, and inevitably something does, we don't want to get sucked into somebody's project, right? Like we probably at any given time have 60, 70 loans out in the market, and our goal is to get paid back. Our investor base, which is a mix of large institutional investors, pension funds, insurance companies, family offices, high net worth individuals, like they're looking to get their coupon, their interest payment paid, and rinse and repeat, like not get dragged into a multi-year complicated fight, right? So, while I think there's some folks that might say, oh, you can make more money doing that, that becomes an incredibly time-intensive exercise, and it's also not how I want to spend my life. I think, we've all experienced in the real estate market, I feel like in particular, most folks are more transaction-oriented. And I always found it ironic or funny when, I'd get a change order from a contractor. And of course, like there are legitimate change orders, but there's also ones where you just are being squeezed. And I was like, you don't think I'm going to remember that, on the next project? And so I felt like if you took a different approach that was sort of more transparent and communicative and partnership oriented, that would be like differentiating in the market. And it's proven to be.
Let's talk about some of the challenges that have come up in the projects that you all have done together and how you guys addressed those challenges. What did that look like?
Sure. The first project that we did together, my takeout lending options were very limited. And I remember, and I think it's important to admit to, the ones that didn't quite go the way that you had hoped. In the very first deal that we did, I actually had to put cash into the project in order to make Seth whole. I wasn't going to leave you short-shrifted because the lending environment on the other side of the pandemic just was depleted and had been was sorely limited. But we were pretty good to each other during those months.
And I think it comes down to, how you deal with any kind of challenge and being communicative. I mean, I think it's sort of the word we focused on.
Yeah.
And, not sort of taking these strong positions without a conversation about what each side is trying to achieve and what their objectives are, what their sensitivities are. I mean, I know like in that situation, which by the way, everybody encountered.
Correct.
And, one of the things we sat down and we looked at, okay, where are the takeout lenders coming in proceeds wise? And everyone was short, right? And we talked about options. Well, one option is you put additional funds in. Another option we discussed is we would provide preferred equity, right, behind
we looked at that too.
Behind the lender, or behind the senior lender to help him lower his cost of capital. Obviously, we were going to charge a lot for that, but
or you could also look at accruing, right? So if you can't pay the current rate, you'd have a part of it that would accrue, and you would kind of pay it on the back end if the financing environment improved, right?
Yeah, and I think the important part is you're having that conversation and that dialogue is taking place. Because you're not always going to agree, right? I mean, it's like any kind of relationship. I think the important part is to sort of, not keep it internal and like steam over it, but rather just sort of discuss what somebody's trying to achieve, and figure out, what the compromise is or middle ground or what path forward works. Because Joseph knows, in this case, like what he can do, and I know what I can do, right? And you're trying to figure out what those options are. It reminds me of I remember in business school, there was a negotiation class. There was an orange, and both sides were trying. I don't know if you've heard this sort of famous case, but like the negotiation class was how to win
skin
over this orange. And one side actually just needed the skin, and the other side needed the fruit. But neither side knew what the other side needed. So you had this whole back and forth about how to negotiate to get this orange. And the point was, well, if you just understand what the other side needs, maybe actually there's not a conflict there. And so I think about that oftentimes when we have these situations, to try and understand what somebody's ultimately trying to solve for, and then see if we can, create a solution that works for them, works for us, and for our investors. But you can't get there unless you're having that conversation.
Remind me how much you spent on that MBA?
Yeah.
This is why you got into real estate development, right, Joseph?
Yeah.
Let's back up a second. Tell us why you got into real estate development.
What I love the action, right? So being a developer, you're getting your hands dirty, right? So you take a project from inception, from a piece of paper, and you bring it all the way through, and you get to then do a ribbon cutting ceremony and welcome tenants in, and then people live in your buildings. I went back a few months ago to that first project that we built together, and I was across the street and I was looking into the building and I saw tenants. The building has been occupied now for 5 years, and I just see tenants living in that building, and I'm like, oh my God, like they have no idea that the developer who built that is across the street looking into their window.
It wasn't creepy.
It was not creepy. It was not creepy. I mean, I spent a night in the gym. It's unrelated. But it's a remarkable thing. It's a very creative thing. It kind of appeals to my personality, right? You don't really meet too many people in real estate who are reserved, sedate. It's a generally charismatic, energetic crew, right? And so it just checked a lot of boxes for me. And if it goes well, right, it can be a very gratifying thing.
Well, let's talk about the balance between creative expression,
Sure.
creative freedom, that's the desired
Sure.
state of
Sure.
being, and financial responsibility,
Sure.
like real world responsibility, and balancing those things across projects. And like maybe how y'all, when you're talking about the challenges, talk about those things.
Sure. So the reality is that zoning dictates 75% of what you can do. So before you even bring your designer in and you say, let's talk about the facade, and like zoning tells you, this is going to be what you can basically build. Like it's already done so much of the heavy lifting, right, for you. And it tells you how high you can go, what bulk, what density, right? So zoning takes care of a lot of that. Listen, I'm not a condo builder, right? And so I generally build multifamily rentals, right? And I generally build for a middle-class young professional, someone who makes maybe $200,000 a year. This is maybe their second apartment. Maybe they're coming into New York for a job. Maybe they go to graduate school, right? So I know my target demographic. I know what my
Why
tenant
that
is.
market as a target, out of curiosity?
Yeah, I mean, one, they represent a large swath of the tenant pool, right? We could talk about why I don't build condos, right? It's a riskier business model, right? My portfolio is 100% occupied, right? I never really worry about the absorption risks, the occupancy risk in New York City, right? Versus with a condo business plan, if you can time it, it is the most beautiful thing in the world, right? You think about Vornado and their tower on Central Park South. I mean, they crushed it, right? And that was due to Robert A.M. Stern, Vornado, timing, right? The location. But absent of those things all aligning, on a risk-adjusted basis, it just kind of felt better for me building, a rental. I knew that at the end of the day, if I could deliver it, they would come, right? And then typically speaking, I've been building in Upper Manhattan, in Central Brooklyn, right? So these are, the typical people who want to live there. They make $250,000 a year. It's actually been remarkable, Seth, to watch in just my time, wage inflation, right, in New York City. And I see all this data coming through, and it explains why rents have also just grown astronomically, because wage inflation has just been tremendous. But in any case, your target tenant cares about location. They want they want certain sizes, they want light, they want air, but they're also not going to care about a lot of things, right? So we make a decision, do we use P-tax or central air, right? I hate P-tax. I hate the way they look. They look disgusting. They're boxy on the outside, they're boxy on the inside, but it also costs $3-4 million more potentially to do central air. And I know no one's going to pay me more for that, right? So you end up making a concession. The architect will kind of bitch and moan, excuse my French, but there's no economic reason when you're building a typical multifamily to go central air. Obviously, a different calculation if you're going condo, but building rentals, you go P-tax all day, every day of the week. So that's, I think, a good example of some of the decisions that you have to make.
What do you think about that balancing equation?
It's critical. And I think, one thing that on the development side of our business, you want to have a positive impact in a neighborhood, in a community. You want to have pride of ownership on what you're delivering. But you do have to have that balance and the sort of understanding of what the market will award and recognize. And, ultimately we're fiduciaries to our investors. When we're getting a project request, we're looking at how will the market accept this product, right? Is it the right unit mix and programming and design that will resonate? And that's critically important. So, for us, I personally think it's actually helpful to have some constraints. Sometimes you see, especially in the high end part of our business, where there's, more open-ended budgets, right? Like you can sort of do whatever you want, but if you have to achieve a certain hard cost per square foot or, pro forma and budget, I think that can be a helpful, creative constraint. And you find that, you do this very well, right? On Sterling, the material selection, right? I mean, those are, if you walk that project, you'd say these are condo level finishes, in other parts of Brooklyn, right? Or even Manhattan. But I think you're able to figure out what the selection is that delivers that aesthetic, has that same durability, but is not 3x the cost.
Totally. And we've gotten very good at our pre-construction, right? All the mistakes are made at the beginning of anything, right? And so if you are able to make all your tough, difficult, wise decisions before you've broken ground, before you've dug a hole, before you've gone up, it just makes for a lot more expedited of a delivery. And I think that's what you saw at Sterling, right? At Sterling, it took us 15 months to build that project. The pre-development itself, right? So you're making all these decisions about which subcontractors to hire, what materials to use. That period took longer than the construction, right? And the construction went so quickly precisely because we'd spent, relatively long period of time making all these planning decisions.
In any design or real estate project, a project is aided by a set of constraints, no question. But let's go to risk for a second. You want to limit your downside risk, but is there enough risk being taken now in the real estate development world and in the world of capital markets relative to what the world needs, and what we would all like to see?
Yeah, I mean, for me, I think it's important to highlight and for people to recognize that, when you're attracting capital to projects, right? And this is whether you're in Joseph's seat as the equity or me as the debt, right? Our investors, they have, myriad options for where they can put their money, right? I'm dealing, major, state teachers pension fund. They're going to do regular private equity. They're going to do venture capital. And there's a certain, return threshold that they're looking to achieve. And I can't come to them and say, you're going to earn 6% on this ground up development project, because they're going to say, well, 6% I can earn 5% in treasuries, right. Or I could earn 7 or 8% holding corporate bond. They have a diner style menu of options. So you have to be competitive within that set, right? And similar for Josef, and I think this is one of the challenges right now for raising equity for the real estate projects. Is I'm the lender. Our average rate is probably around 11%, and we're typically
Fortune.
No, I'm 60 to 65% loan to value typically. So if they're earning 11% at 65% loan to value, how much more do they have to be earning?
Correct.
To be on the equity and taking that first loss position?
And if I'm borrowing from Seth and I'm paying him 11%, and then I have to deliver 20% to my equity, where are you buying that free land?
Right. And then
it's so hard to find those opportunities where he gets paid, he gets fat, and I get fat. That's a challenge. Right?
And you understand it, because if you're an investor on Joseph's project on the equity, or you're with me and you're saying, well, I do have all these other options now, right? And maybe I didn't have pre-rate hike.
Yeah.
Right. But now there's a ton of fixed income options. There's a ton of hybrids. So we're all set by that world. So I do think, unfortunately, as a result, the response needs to be, how do we look at zoning? How do we look at tax incentives? Maybe it's tax credits, maybe it's tax abatements to
Opportunity zones
to incentivize capital to come into these projects. But to take risk, you have to earn a commensurate return.
Right.
And if that return doesn't exist, that risk is not going to be taken, which is why we have such a tremendous housing shortage.
And to echo Seth's point, there is no dumb money out there anymore, right? So 10 years ago, there was a lot of dumb money, and dumb money was chasing VC deals. It was chasing these real estate ventures. When you have interest rates where they are today, there is no dumb money, because that dumb money, has either put it into treasuries or just, again, there's so many competitive uses to deploy capital, right? And developers are also doing things that other sponsors and other entrepreneurs are not. So for example, guarantees, right? A developer has to guarantee often a loan, right? So his downside can be really, really, really bad versus I'm an entrepreneur. I just started a company. I don't have debt. I'm raising VC money. If it goes well, fantastic, 100x. If it goes badly, all right. So we lost a little bit of money. On a real estate venture, if the project goes belly up, you're on the hook for guarantees. You're on the hook for completion. You're on the hook for carry it. Your life could get ruined, right? And so it can get very dicey, very scary for the developer. And as such, the developer should just be very wary not to overpromise anything.
So how do we align incentives and interests, right? I mean, just step back for a second, going to risk. I asked, should we be taking more risk? You seem to be saying we should actually go in the opposite direction. We should find ways of de-risking projects that would allow for more projects to take place, right? And we can do that through policy. What are some of the other ways that we can de-risk projects and therefore do more projects and get to better alignment?
I think, listen, over the past few years, you mentioned the 421A, right? The 421A program, which is a program which kind of exists, it's been extended, the Affordable New York program, like the current program, the 485X, these are real estate property tax abatement programs. So they're programs to incentivize developers to build new construction, but also with an affordable component. Because otherwise, without the abatements, your real estate taxes are around 25% of your revenue. So being able to cap that at 5-7% so that you can pay your mortgage, so that you can pay your your operating expenses, so that you can distribute some profit, that's a ball game. New York City and New York State have introduced a swath of new legislation, right? So we have new tax abatements for ground-up construction. We call it the 485X. We have new tax abatement programs for office conversions. Those are called the 467M. End of last year, the city passed the City of Yes, which, net, I think is definitely a positive monumental thing. So these are all great pieces of legislation that are certainly de-risking construction and development in New York City. They're not perfect, right? So for example, if I want to build a new project under the 485X program and I want to build it above 100 units, I then would have to pay a certain wage premium, right? Which makes a project that much riskier. And it's interesting, you probably saw this yesterday, The Real Deal announced that of the 2,600 projects or units that have registered for the 485X program, not one project has more than 99 apartments, because 99 apartments gets you into a certain class of project, and developers will not take that risk. So they're not going to take the risk when it comes to the wage premium. I think if you want to build a project of a certain scale in Manhattan, you may have to pay more than $72 per hour as a floor, right? Which is a fortune, right? I mean, that's 5 times minimum wage, 4 times minimum wage. Even in parts of Brooklyn, you're paying 65, right? So that incremental risk is probably a bug that needs to be sorted out. And if I could wage my magic wand, I would raise that cap and say, listen, it shouldn't start at 99, but maybe 300, right? That's what the old 421A program said. Any project above 300, then the wage premium kicks in. So I think around the edges, this is where I would be thinking about de-risking projects.
This podcast is sponsored by Riley Architectural Windows and Doors. I have personally worked with Riley on several projects, and they've become a go-to partner for me and my architectural firm. Their team is warm, responsive, and technically outstanding, from the ownership to the project managers and through to the fabrication team. They make custom hardwood and metal windows and doors with true artisan-level craft at their shop in Calverton, New York. And they handle everything from design support to installation and maintenance across the United States. I actively seek out new opportunities to collaborate with Riley and look forward to working with their team on many future projects to come.
I have probably in my inbox now 3 or maybe 4 projects that are new construction, multifamily proposed projects. What are they doing on these very large lots?
They're just subdividing them.
They're building multiple buildings to keep below the 100.
Right.
Because a developer
It's more expensive, more core, more...
It is,
Totally.
but
It's
it's
inefficient.
less.
It's environmentally, wasteful, right? You're pouring all that more shear wall, all that more concrete being terrible for the environment, right? You're building all these new lobbies. You have staffing issues. You now have to have like multiple supers when you could have had one, multiple porters when you could have had one. So this is going to be fixed, I imagine, over the next 2-3 years, I hope.
But it's less expensive than paying that.
Correct,
70,
because
whatever
you're
that
otherwise
was.
paying 20% more, right? But there are other elements to the 45X in addition to the wage premium that make it risky, right? So if you're building more than 99 units, you're also exposing yourself to labor disputes, right? So subcontractors can actually come after you if your paperwork is not in place, right? If they haven't been paid their fair wage. So that paperwork becomes also very difficult to track down and hold. And then you're opening yourself up to subcontractor claims, the HPD, and they can take away your tax abatement, right? So there's a whole world of risk that you're opening yourself up to by virtue of building these larger projects.
Yeah. And a developer, they can't pay the cost of land, they can't pay the cost of construction and achieve...
Can't pay Seth's rate.
Can't pay my rates and achieve their required rate of return that investors demand, right? And those investors, they look at it, okay, New York as an example, they don't need to put their money here. And they take on all this liability. You've also seen the same dynamic with rent-regulated housing throughout the city.
Right, good
right?
cause, and not,
Well, yeah, I mean, people are like, well, why do I want to put money in New York when I can invest in the majority of the country, especially in the Sun Belt where I don't have these issues? The compliance stuff, I mean, it sounds good in paper, right? Like, I think it feels like a lot of legislation is written for the headlines, not for the actual article. And it sounds good, but then you realize that, well, actually that, third or second generation family that's owned that, walk-up building, for 50 years, they're in the real estate business, but they're not really set up to like handle.
They're not real savvy real estate operators.
Also, you have to have a full compliance department to the lease review, the renovations that were done 20 years. I mean, nobody's set up to do. I mean, if you're the related companies, maybe you're set up for it. But the majority of owners in New York, it's not that. It's smaller, entrepreneurial owners or long-term families, and that might be their only asset. I mean, we had bought a building years ago, and it was a woman that owned a building for 40 years, and she's just like, I just, Seth, am not able to do all the things that they want me to do. And it's not that she wasn't well-intentioned or a good person. She was like, just not able. She's just not set up for it. So I think New York just has to be really careful and really look back at how can they fix all the bugs that frankly they created, but have led to a lack of housing throughout the city. And it's really the biggest driver to me of the affordability crisis. And I think on new construction, I mentioned zoning incentives, right? They have made some changes. They adjusted the sliver law. I mean, there's things that they're doing. I think whether it's the tax abatements or tax credits, they just need to align the lever so that the capital markets and developers want to go and can capitalize and build these projects. I know hundreds of developers just because of the seat I sit in. There's not one that wouldn't be happy to build multifamily affordable housing if it made sense. Everybody would do it. So it's just putting the pieces in place. I mean, I don't know if you feel similarly.
But to New York City's credit, it's also a remarkably responsive city, right? So in the last few years, they have, as we talked about, they've really introduced a lot of legislation. I think the 467M, for example, is one of the single greatest pieces of policy that I've seen over the past few years. Like, the pandemic obliterated the need for half of New York City office space, boom, you now have a great tool, a great new toy to convert all this obsolete Class B, Class C office space, right? So it'll take time. And I think it's responsive government is actually also one of the reasons why I think New York City continues to be a good place to invest despite the frustrations. You do see real progress being made. And I do think it's a very exciting time to be a developer in New York City despite some of these frustrations that we talked about.
And New York has an unusual dynamic where you have regulations and rules that are determined by the city and then stuff that's determined at the state level. And I would say more broadly, and this is not just specific to New York, there does feel like there is a YIMBY backlash.
Totally.
That people have recognized that there's problems, that they need to be more receptive to development.
And that swing has been very quick. You saw this wave of DCA candidates come in 2020, and now you've seen a lot of them have to exit stage right. And you've seen a bunch of very charismatic politicians of color, people of color, who realize that in order to fight gentrification and displacement, we do need more development. And that has happened in the last 5 years.
Yeah. And you think about a project like yours, right, that has affordability requirements. Like, that's a perfect example. It was a parking garage, right? And now it's
80 apartments. We had a third of it dedicated for income restricted, affordable, and we received 10,000 applications for those 23 apartments, which is crazy. And to your point, if you could make naturally affordable workforce housing pencil, you would do it any day of the week. One other thing that I should mention, one of my chronic frustrations is collections and delinquencies in New York City, right? Another risk, for example. Once you've built the thing and someone has stopped paying rent, it takes so long to get them out and to evict them. I have a tenant.
Maybe make up her first name.
Maybe. We'll call her Jane, right? Jane has not paid rent since April, not of 2025, of 2024. She now owes $60,000. And every time we go to court, the court case is adjourned and it's pushed back. And the next court case is now July. Yay. So by that point, she'll have owed us $75,000. She's living for free, right? But it's not really, she's a problem, right? But to your point, there's this legislation that protects that delinquency. And so, in fact,
it arguably incentivizes.
And it makes kind of a laughing matter of anyone who pays rent. Like, you're an idiot. You could live in this building for free, and she has been living in this building for free, stealing from her landlord, right? Enabled by the political climate, right? So that's a risk as well. And on a large building like this, so Jane lives in a building that's 113 apartments, right? Okay, so we have one bad tenant, another one, we'll call him John. We track them. Their Uber ratings have just plummeted. But, a building like that can kind of support that delinquency. But you talked about these small landlords. If I have a 5-unit, 6-unit building and one person stops paying rent and has effectively decommissioned 1/6 of my revenue, and I need that to pay my mortgage and to pay my bills, right? I mean, you've crippled that landlord. And I think what we're going to see over the next...
And led to a lot of defaults on loans.
Totally.
Right? Because they don't stop the water, sewer bills, the real estate taxes. There's no relief there.
And there was a fascinating article in the New Yorker that came out within the last week or so, which talked about these small landlords. They're not real estate professionals. They bought something 20, 30 years ago. They no longer can keep up with the compliance, with the delinquencies. They're often immigrants, right? You're seeing this banding together of small landlords who are coming together to say, we have serious problems managing our portfolios and our single assets. And we now need to kind of build political strength, and that's kind of an ironic turn of events whereby you now have landlords organizing for the first time precisely because the situation, the tenants' rights, I mean, those protections have just swung in the opposite
I like
direction.
To say the safety net has become a safety hammock.
Yes.
And it really incentivizes bad behavior.
Yeah.
And we've seen it, in our portfolio.
NYCHA suffers with this.
It's a huge issue for NYCHA.
It's a huge issue because, why, if you're a NYCHA tenant and it doesn't, why would you pay, right? Like, why? There's no reason to pay, right? And so now NYCHA, I think, has $500 million in arrears. Don't quote me on that. You may want to delete that part, or let's fact check it and then keep it in. But, the tenants collective, I think, but again, of course, why would they pay? And once you've broken the first month, and you're like, whoa, no consequences. You go a second month, no. 14th month, 15th month, no consequences. So again, going back to policy, because to Seth's point, he's drawn a distinction between capital markets and policy, right? Or local policy. We can't really do anything, about the capital market side. They are intertwined, but you can't, we can't really influence capital markets here in New York.
But except,
right?
With me, I remember we expanded our business nationally about 5 years ago. Part of that was because I would be having regular conversations with investors, and they would say, and maybe it was because they were watching, too much Fox News, but they would be like, New York's like Fallujah, like what is going on there? Like, I don't want to put money there. And so there is an element when you hear these stories, right, about collecting rent, these anecdotes, all the various restrictions, and they're well-intended, but just absolutely terribly executed. I understand and I have empathy for people who are in a situation where maybe they've lost their job and they need some time. That's not a year, right?
You don't need 16 months.
Yeah, we had a tenant who 2-bedroom apartment, and she was behind on her rent, and she was like, I can't make my full rent. And our property manager proposed, have you thought about getting a roommate? You live alone, 2-bedroom apartment. And she's like, I don't want a roommate. I'm like, well, I didn't want a roommate when I moved to New York either. But you know what? I couldn't afford a 2-bedroom apartment on my own. So I didn't live in the 2-bedroom apartment. But it's like, these are
a crazy story.
Universal stories, right?
Totally.
And when investors or even lenders hear that, right, they're either not willing to put money into New York, or the type of capital they'll lend, and the reserves and the debt service coverage and the vacancy and credit, they will pull back. So the policy does, to your point, directly impact the capital markets, and then it becomes a vicious cycle, because it's like, I'm not going to be able to give you as much, or I'm going to have to charge you more for the regulatory risk.
There are two sides to this coin, right? So you can, we love to hate on New York, but then in the same building that I mentioned where Jane and John both owe a fortune, it's 100% occupied. And those rents have gone up and have gone up and have gone up. And because it's new construction, right, it's actually a protected class within real estate, right? So good cause doesn't affect new construction, right? They're like, good cause, those crappy pre-war and post-war, let's, smother those. But, we want to incentivize new constructions, right? So I'm protected by virtue of it being new construction. So you have your Johns and your Janes.
They should get together.
Actually, I think they're in cahoots. They're on a WhatsApp together. But at the same time, you've seen tremendous rent growth. And that story is unique to New York, right? And you've seen, in Manhattan, the median rent is $4,500, right? Which is ridiculous. I remember when I moved back.
I think it might be more than that.
It's probably more than that, right? And, this past month at this building in Clinton Hill in Brooklyn, lovely part of Brooklyn, we renewed, of the 11 people that were coming up for renewals, we renewed 10 of them, all of them at 5%. That incremental value to the building was substantial just for that month. And it more than makes up for the Jane and the Johns who clearly need to get together. So again, I think it's a very difficult business. It's becoming increasingly difficult. But I think that accrues potentially, this is what I tell myself.
Well, to the incumbents.
To the incumbents, but also to the savvy and sophisticated, developers.
But
right?
that rent growth wouldn't be there if there was sufficient supply.
Correct.
Right?
Correct.
So if you're an incumbent, if you're a homeowner or an existing building owner that has the profile of free market units like you do, then you're in a good position.
Correct.
But you're only in a good position because the supply isn't there in the first place. And frankly, people bet that probably continues. I don't think that's great from a society perspective, but for sure that's the dynamic.
Looking ahead to the coming months and, your current businesses, your ambitions, what you would like to see happen, and also what you wouldn't like to see happen. What are you afraid of? And what are you excited about and looking forward to?
I'm excited to do more business with you, Seth. Or maybe I'm hoping to actually graduate. You mentioned 11%. I was like, oh my God, if I'm still doing 11% loans in the next 6 to 12 months, I've done something wrong.
We did close one today that was just under 10%.
There you go. But despite everything that we've said, about collections, about delinquencies. I still think if you can build new multifamily rentals in New York City, right, it is a great business. It's, you deal with the Janes and you deal with the Johns, but otherwise it's pretty operationally easy, right? All you're doing is you built it and then, you collect rent. Like it's not like you're managing a hotel, for example, or a real operating business. So it can be a really great business, And so if I can continue to build more of these great multifamily buildings, under 100 units for the reasons that we discussed. That's what I want to do. I want to put more points up on the board. Again, I think New York City is so dynamic. I love this place. I grew up here. I'm a big believer in New York. So I want to continue growing my business here. I've looked to do business elsewhere, and I haven't convinced myself. I was like, if I could do a deal in New York or a deal in Chicago, no, I'm going to stay here. I'm going to build it here. So I want to do more of the Sterling projects. I mean, that project in Crown Heights, 80 apartments. We received 10,000 applicants for 23 affordable apartments, which is insane. The rents we're getting there for 2 bedrooms. This is in Crown Heights, right? So it's 45 minutes from Midtown, right? 6,000 for 2-bedroom apartments. Right? That's insane.
That's
right?
affordable?
Well, no, those are on the free market side, right? But they're spacious, right? So people are willing to pay a premium to live in a spacious 2-bedroom, 2-bathroom, right, with nice amenities. But those are still great numbers, So if I can do more Sterlings, I would do that any day of the week. We're looking at a few things at the moment within the kind of Prospect Heights area. That part of Brooklyn along Atlantic Avenue is being rezoned, right, to allow for around 4,500 new apartments. I think it's a great neighborhood. If I could buy a site there over the next few months and take advantage of that new policy and maybe bring that loan to you and maybe, 8%, 9%.
You get friends and family at this point.
Get friends and get a discount, yeah. That's what I'd like to do. What about you, Seth?
Well, I think also just to comment, Joseph, to your credit, Joseph's built an incredible team. He's learned
That's
a lot.
That's going to cost me a point. Every time it comes.
yeah, each compliment's a 50 basis points.
Exactly.
But, you've learned from, each time where, maybe you did something that you would do the next time, and you see it. You see it in Sterling and your sort of more recent projects. The design is there, the unit mix, the programming, the layouts, the proportion. You have a really good formula and a really good team to execute on that. I will say, because I sit in the seat where I see a lot of projects, that's not that common, right?
I'm a special guy.
You're a special guy. You're a special guy, and you built a special business. For me, in terms of, I think the thing I'm most concerned about is ongoing volatility, right? And I'm mostly speaking politically. Both at a national and local level, because volatility is sort of the enemy of any investment, right? It forces people to sit on the sidelines, to not do transactions, to not be able to plan. What's my budget going to be like? What's the impact of tariffs? Like, it's the swinging back and forth is can undermine market stability, and has undermined market stability. So that's the thing that I shouldn't say, I'm concerned will keep me up. Like, that keeps me up currently.
And you're talking about the difficulties with fundraising?
It impacts everything.
Yeah.
Fundraising for me, fundraising for our clients.
Yeah.
We have a project in California right now where, they had it bid out pre-tariffs. They went back. No contractor is going to give a GMP, or if they're going to give one, it's going to have such a margin built in that they're sort of stuck, right? They own the land, they have the approved plans, the shovel ready, we're ready to go, but all of a sudden their numbers have moved. That's not great. So we've seen that dynamic a couple times.
Just stretch your loan. Go from 70 to 75.
But, I think for them, they're also like, well, do I build this? Does this make sense anymore? I think that will ultimately calm down and work out, but that's a real issue. For us, the opportunity has really been in taking the same sort of like relationship-based approach and building these partnerships with top operators and developers and scaling the business across the country. The way we've grown has been pretty organic. It's been really following borrowers of ours who are active in existing markets and asked us to bring our lending program to those respective markets. So I think we can continue to sort of build that and enhance that formula, then I think that will be the opportunity. Right now, probably half our business is in the Northeast, about a quarter is in the Southeast, and the rest is sort of sprinkled around the country. I love New York, but we've had to diversify. It's been great. I love spending time in other markets. I love doing it with partners who are active in those respective markets because it makes it easier for us and, sort of a safer way to do it. But I think that's the opportunity for us is to do our growth across the country.
What else, guys, would you like to share with the audience before we close out for the day?
Well, do you have from your perspective?
Everything you need?
Well, look,
you have a unique seat. A different lens.
Yeah. I mean, from where I'm sitting, I want to see people empowered to do more of what they want to do, right? For you guys, you want to be able to fund more projects. Seth, Joseph, you want to be able to build more projects. Somebody else wants to be able to design more projects. A contractor, wants to build more projects, sitting in a slightly different seat than you do. But it's all interrelated. So that's how I'm coming to this conversation and many conversations. And, it's a tricky question in all honesty. And it's a layered question as has been reflected in our conversation. So look, really appreciate what you guys bring, your ideas, your energy, your enthusiasm, and look forward to seeing what y'all do in the future.
Likewise. Thanks so much for having us.
Yeah,
Seth,
thank you.
Thank you.
It's been a pleasure.
That was Seth Weissman, the founder and president of Urban Standard Capital, a real estate and private equity firm focused on debt and equity investments across the United States, and Josef Goodman, the founder and principal of Haussmann Development, a New York City-based residential real estate developer. Seth and Joseph recently closed out their 5th project together, and they are actively discussing new project opportunities. Thanks so much for joining us. If this episode resonated with you, the best way to support the show is to share it with a friend or colleague, someone you think would appreciate this conversation as much as you do. And if you haven't already, please take a moment to rate and review Working Together on Apple Podcasts or Spotify. It really helps new listeners find the show, and it means a lot to us. Thanks for being part of the conversation, and until next time, keep building, keep questioning, and keep working together. This episode was produced by the team at Radio Kismet, including Christopher Plant and Justin Berger. The production and editing staff also included Brick and Wonder team members Ed Thompson, Carrie Potter, Roya Osuli, and Amanda LaFontaine. I'm Drew Lang, and you've been listening to the Brick and Wonder podcast.